we could go on. The only place that you might really push back is where I did. Investment demand will be weak, or what he shows. I disagree. And you can make an argument. There's some guys out there saying solar will be replaced with graphene or copper. It's possible, but really not very probable. So, I mean, this is all you need to see. I've shown this a couple of hedge fund managers that have decided that gold only isn't the way to go. They want to put silver in the portfolio. An increase in the price of gold will increase the price of silver. That has not been the case the last few years of this. And now they're starting to show their fire, their impetus. I don't know the right word, but they are signaling that even with all this problemos around the Mexican situation, and maybe I went too far on a rant, but honestly, yeah, I think it helps the whole industry if we have wide margins that are reasonable, and if silver decides it's $200 an ounce, so be it. Let the market decide. As Bill said, let's hit this dog wagging the tail for a change. January affair. And now I think it's come back and it put normal back in the quotation marks. But based on what's sitting in the registered inventory and the eligible, we're 100 million ounces greater in inventory January 2026 than we were in January 2025. 100 million ounces of physical. I'm not talking about the printing press. And this rollover thing is misunderstood by too many in the industry. They don't understand that there's a huge amount that gets rolled over into the next delivery month. And why? Because what Bill teaches, everything is credit. And they have a physical metal that they own. They're going to put it up on credit, which is the futures market. They're going to get that 1% per month on leverage. If you got 1% a month and you got a 10-to-1 leverage, that's what your interest rate is per month. And they do it over and over and over. And it's been that way since I've been studying the market at that level. I mean, I don't know much about the COT. I was the first guy to learn about Ted Butler. He and I were the only guys writing about silver in the year 2000. Got his phone number, called up Jupiter, Florida. Hey, is this Ted Butler that's writing about silver on Gold? I forget the name of it. Help me out. Vronsky's website, Gold Eagle. I said, yeah, it is. And I said, hey, man, I want to learn from you. Tell me about this. So I really got in. I've been a futures trader for a living. So I had, a pretty good background that most people that talk about this market never have done. But I've never been a futures broker. Anyway, I digress. So I learned more and more. But it's going to fail when it fails. It's not this month, I guarantee that. But what Bill says, I'm in alignment. And that's why, if you want to show it now, Danny, and show that Word doc that I sent you, comes from Matt Watson, who's an independent analyst, friend of mine. And what that shows you is what the ongoing supply deficit looks like for silver over the next 2 decades. And what we see is everything above that red line is got to be taken from above ground inventory. Well, you don't have to be a rocket scientist to see that you don't have to go out too many years and you've basically, at least in theory, eaten up the entire above ground silver supply. Those are all facts. Now, whether he's got the exact amount of solar need in the year 2030 or not, I don't know, but it's a good educated guess. Same thing with brazing, same thing. The only place I really disagree with him, and I think Bill would agree with me, is that the gray or the silver bars at the very top are investment demand. And he has that as a robust 200 million ounces annually and never increasing any years going forward. I disagree. I mean, you look at how the ETF in India and you look at what Shanghai's doing, I think those bars are going to be much higher than what he forecasts going forward. So what I'm implying here is that the amount of silver above ground that would have to be met for all demand, physical demand for industry, physical demand for investment, will, in theory, run out a lot sooner than what it shows on this chart. So you can't be more bullish than just looking at this fact alone. And at the top, it says silver demand low case. He had a case that shows even greater demand in the higher case, which I didn't want to show. I wanted to remain conservative on what I pretty much could prove. Now, we could go on. The only place that you might really push back is where I did. Investment demand will be weak, or what he shows. I disagree. And you can make an argument. There's some guys out there saying solar will be replaced with graphene or copper. It's possible, but really not very probable. So, I mean, this is all you need to see. I've shown this a couple of hedge fund managers that have decided that gold only isn't the way to go. They wanted to put silver into the portfolio.
Silver recently tested a major resistance level near prior highs. Yet investor psychology feels completely different from January's euphoria. Back then, prices surged nearly 70% intra-month, before crashing more than 30%. Today, the metal sits near similar levels, but sentiment indicators show neutrality rather than mania. This emotional reset is significant. Markets often advance strongest when optimism is restrained. Technical signals like MACD crossovers suggest upside momentum is rebuilding. Instead of a speculative frenzy, silver now appears to be consolidating strength. If resistance breaks convincingly, the next leg higher could be less chaotic and potentially more sustainable.
I agree with Bill. I mean, normally, and what's normal these days, but normally you will see the shares will start to set the scene for a higher metals price. In other words, the shares usually anticipate an increase in the price of gold, an increase in the price of silver. That has not been the case the last few years, as Bill said. And now they're starting to show their fire, their impetus. I don't know the right word, but they are signaling that even with all this problemos around the Mexican situation, the shares are starting to take flight. And I think this is where true value lies if you're late to the party. The earnings have come out. Most of the companies we follow, I haven't read and listened to every transcript on the quarterly earnings, but the ones I have, I think every one has beat earnings. And Wall Street's starting to wake up. Really, if you're objective and you're not, biased towards, metalheads or resource investors or people that talk about inflation in reality, just on a pure earnings basis, the gold and silver stocks are your value plays. These are value investments. These stocks are selling at relationships to the gold and silver price that are far lower than the real world. You're looking at, round numbers, $30, $35 silver when we're at 90, triple that price. You're looking at round numbers, maybe $3,000 gold, and we're at $5,200 gold. And so we're going to see these earnings continue to increase, and Wall Street is going to pay attention sooner or later. The Druckenmillers and some of the real savvies are already in this space, but the Johnny-come-latelys, the follow-the-leader types, they will come into this market. And really, remember, the ETFs were started so that stock investors could buy a commodity, because Section 7 people cannot buy commodities for their clients. So ETFs were created. That's where the GLD was the first one, and the SLV was not far behind. But now, if you want the golden goose, or do you want the golden egg? If you want the egg, buy the ETF. If you want the golden goose, buy the mining companies. You're buying them at a discount. You're buying that goose for half price, so to speak. It's going to keep laying more gold eggs and more gold eggs. Why not take part of that? Of course, I'm selling my book. I do specialize in resource stocks, not just gold and silver. But let me tell you, there aren't too many clients I have that are unhappy right now.
No. Long-term fundamentals remain compelling. For years, global silver demand, driven by solar panels, electronics, and investment, has outpaced mine supply. Countries like China and India continue accumulating physical metal, shifting influence away from purely paper-driven pricing. Above-ground inventories are finite, and new discoveries have slowed after a decade of underinvestment. Meanwhile, money supply growth in major economies continues to outstrip mine production growth. The math is simple: expanding currency units versus limited tangible assets. Over time, that imbalance pressures prices higher. The structural deficit story hasn't disappeared, it's quietly deepening.
Yeah, I do. I mean, having been to, I wouldn't say more mines than I can count, but in the hundreds over the last 40 years. One of the locals, it's an hour and a half from where I'm sitting, the Lucky Friday mine in Idaho. I've been in that mine a few times. But I did an analysis back, 15 years ago. What I do know is the price was $17 the ounce. But the true cost, not the cash cost, which is kind of BS, but the true all-in sustaining cost was 17. So they were mining silver at a high grade, but they weren't making any money. Why? Because in the United States, you have workman's comp, insurance, healthcare benefits, dental care benefits, pension plan. I mean, of all these things for a U.S. worker that you don't have in Argentina or Mexico. So that puts it I'm really trying to emphasize what Eric said. now if you get let's say a living wage out of the mining industry and you're selling silver at $90 and you've got real earnings, now you have a margin where you can pay American wages and get metal and bring it to the fore. So I think it's a good thing. I'm not for inflation, but I'm for real wages in the real world. And honestly, I think the working conditions should be better than they are in most countries. I'll just digress for a moment more, but I've been in Argentina and I feel for those guys. I mean, they're away from their family 6 months, living in tents, working 12-hour days, and they don't get very good food either. I mean, that's kind of, that's the deal about the mining industry. I mean, it gives you a real look at how the other half or most of the world lives. So maybe I went too far on a rant, but honestly, yeah, I think it helps the whole industry if we have wide margins that are reasonable, and if silver decides it's $200 an ounce, so be it. Let the market decide. As Bill said, let's hit this dog wagging the tail for a change and see what happens in the industry, from the miners to the explorers to the exchanges and everything else.
Geopolitics adds another layer. Mexico produces roughly a quarter of the world's silver. Any instability there raises supply concerns. Yet mining equities are rallying, with funds like Global X Silver Miners ETF and VanEck Gold Miners ETF pushing toward highs, even outperforming the metals themselves. Historically, miners often lead price moves because markets anticipate future earnings. With silver near $90 and gold above $5,000, margins have widened dramatically. Higher energy costs could raise expenses, but current price levels more than compensate. For investors, miners now resemble discounted cash flow machines in a strengthening commodity cycle.
Way over to gold. Gold is
before we do, just let me say that I reposted a Twitter feed, and we just saw a decline of 14,196 large contracts yesterday, which is 71 million ounces. So it's going more toward the format that Bill outlined that used to be the case. I mean, for years and years, the rollovers just spent a lot of paper, got pushed out the next delivery month with an inconsequential amount of physical being delivered. And what he did say is accurate. But just for the record, it looks like it's going back to what, again, I used the quotation marks, normal conditions. Go ahead and give me your gold question.
No, I'm just going to ask.
David, one quick question. One quick question. What happens if there's, I don't know, pick a number, 50, 75 million ounces standing for delivery this Friday?
Well, the exchange has 96 million in register right now, or I think it's 89 million right now. So they would be able to fulfill 70 million or 80 million.
That's correct at the beginning of the month. But at the end of the month, if you go back for the last 2 years, more stood for delivery on final notice day than on first notice day. And that's what I'm getting at is in the past, whatever stood on first notice day, final notice day would always be less. Now it's always more every month.
Yeah. Well, so far it's going the old direction. It's 14,000 contracts, 71 million ounces hypothetically to be delivered.
No, David, you're missing it. I understand what you're saying. It's going down right now into first notice day.
Yeah, well,
first
you asked
notice
me
day, it's going to be a number, whatever that number is. And then by the end of the month, there will be more standing than there was on first notice day.
Gotcha. Well, it'll be what it'll be. And if it's under 89 million ounces, they have that much in the register category. If it's above that, they probably could move into eligible and meet the delivery demand. And we don't know until we know. I'm suggesting that I think it's going to be not a bigger demand as you've outlined. It could be. I don't know.
You guys ready to talk about gold?
Well, we'll know in 2 days.
Yep.
Gold continues to behave as a global reserve anchor. Central banks, especially across BRICS-aligned nations, have steadily increased purchases, diversifying away from dollar dependency. Amid tensions involving Iran and strategic choke points like the Strait of Hormuz, gold's role as crisis insurance is reinforced. Unlike silver, gold carries institutional legitimacy. It is accumulated by monetary authorities, sovereign funds, and large asset managers. Yet silver's affordability gives it unique grassroots potential. In extreme scenarios, gold preserves wealth, but silver facilitates transactions. That dual dynamic keeps both metals strategically relevant in uncertain times.
It would. I mean, gold is acting exactly how I would expect it to under the current economic geopolitical conditions. And the sentiment is right where I expect it to be. I mean, gold's got a huge advantage over silver. I mean, gold is really an establishment metal, and central banks keep buying more and more gold. And it's worldwide. So there is I might say, an insatiable appetite to move the confidence trust meter to more trust and more confidence. If you don't trust the current system, and you see what BRICS is doing and trading in other currencies and the dollar not being used as much in international trade, and then taking Russia's deposit of $300 billion. I mean, all these things play together. And gold is the safety net for everyone, from the central banks down to individual investors. Right. So gold has that advantage. Silver doesn't have that advantage. There's only a few outliers that look at silver having the equal safe haven status that gold has. But what's really interesting, if you look at an extreme, which I wrote in my first published piece outside of my own publishing, which is in the Investing Rules book 20 years ago, and I was asked to write the 10 rules of silver investing. The first rule was no one wants to be a prophet of doom, but in the event of an all-out financial collapse, silver will be the money of last resort, because gold will be too high unit value per purchase price. Therefore, everyone should have a bag of silver or close to it on hand in the unlikely event. And that's the truth. Now, I'm not saying we're going to have a total collapse and need to barter with silver, but what I am pointing out is if that were to occur, it don't have to be worldwide. It could happen in your hometown. It could happen in Argentina when the power's out for 4 days, and you start bartering with silver jewelry, gold jewelry, or what have you. So I'm belaboring the point, but gold has that big advantage. Silver, I think, and I want Bill's take on this, and I'm trying to be objective, I think it's gaining that safe haven, trust, and confidence status more and more as time ticks forward, because it's more affordable and it really serves the main function.
A persistent price gap between Asian and Western exchanges hints at deeper structural tension. When arbitrage spreads remain unusually wide, it suggests distrust or logistical friction in delivery mechanisms. Meanwhile, analysts scrutinize futures positioning data and warehouse inventories for stress signals. If delivery demands ever exceed available registered stock, volatility could spike sharply. Under normal conditions, paper contracts roll forward smoothly. But should confidence falter, particularly in the derivatives complex, liquidity could evaporate quickly. History shows that when the herd finally moves, it often moves too late. In precious metals, scarcity doesn't announce itself politely. It reveals itself suddenly.
Well, most mines, rule of thumb, 25% of their cost are energy costs. You know, if they're running a generator or they're tapped onto the grid, it's very energy intensive. So it would factor into the overall cost. The all-in sustaining cost would go up, not by 25%, but it would have an impact in almost all cases. But I don't think that would deter anybody from buying the mining shares. I think, in fact, it might do the opposite. People get into the mining shares. Of course, it doesn't apply to the royalty companies, which is what we focus on, or apply as much, I guess.
Yeah, I've got the GDX price chart up here, and much like the SIL price chart, the Silver Miners ETF, it too is pretty much knocking at the doorstep of a new all-time high. You would think that that if we were looking to see higher energy prices coming down the pike here, that the mining stocks would not be outperforming the metals themselves, but the mining stocks are outperforming the metals. GDX is outperforming gold, SIL is outperforming silver. What's the overall message here?
Well, markets look ahead. Talk to Bill. He was a stockbroker longer than I was.
Yeah, what does that mean, Bill? Looks like
Markets look ahead, Danny.
Okay.
So it's already factoring, if you believe that, and I tend to agree with that statement. So it's looking ahead, and it's already factored in the fact that we're going to have higher oil prices and still going. That's how I look at it.
Understood. I know you have some other charts here you want to share, Dave. You want to go through some of them?
Yeah, let's Let's look at the commitment of traders. I think it's the first one I showed you.
All right, here it is.
So it shows that we only want to look at the commercial side. So it's from February 17th. So that's the last one I could get. And if you look at the commercial, there's one side that says long, one side that says short. On the short side, there's 79,076, and on the long side, 36,729. So that's two round numbers. 79,000 minus, I'll call it 37,000. And what do we get? 42,000 net long. That's net short. So the banks are net short 42,000 contracts right now. And that's low. Usually they're in the 50 range, minimum 55. It's been much higher. So the point I don't want to make is exactly what the net short position is, but that's how you calculate it. But that there's been people talking about the banks have become net long. And that just simply isn't true. The banks are on the COMEX, net short 42,000 contracts. So that was point number one. You want to look at the stockpiles one in graphic form.
Can you hear me, Danny?
Yep, we hear you. Yep. Is this the one, Dave?
Yeah. And
Sorry
that
about
one's
that,
just,
guys. I told you it was my third interview today, and I forgot to plug my laptop in.
okay.
Don't
So
worry.
going to the COMEX warehouse stocks here, you can see that chart goes from 2021 till basically present day. And looking at it, you can see it's kind of flat between the year 2021 up to the year 2025, around 300 million ounces of silver. And then it just shoots almost straight up in January 2025. Well, that was the tariff scare. That was silver metal moving from London into New York. And it increased it to almost 500 million ounces. And then it leveled off at about that level, a little bit higher. And then it came back off. Now, let's call it 200 million ounces that came in early January, the next few months into New York, leveled off, and then it went back out. Some of it went back out into London because there was an arbitrage going the other direction that developed. But a great deal, no one knows the exact amount. Well, somebody does, but I don't have the exact numbers. But some fair amount went into the Shanghai Metals Exchange and the Shanghai Futures Exchange. But if you just look at that move up, across, and down, we're basically at a level that's higher now than it's been for 2021, 2, 3, 4, 5 on average. So what I'm saying is that was, I wouldn't call it an anomaly. It's just explained by metal London and New York, and then out back to New York to London and Shanghai. But the overall amount is basically where it's pretty much trended for the last 1, 2, 3, 4, 5 years. And that's where we're at right now. Now, if Bill's right, and we get an exorbitant stand for delivery on the final day, and it's greater than the registered inventory, it will be interesting to see. And we will find out in a couple of days.